Exercise 21-10B. Not a whole lot new in this this problem, so we'll just continue taking a look at it. Okay, so on January 1st, 2014, Horizon Leasing Inc., who is the lessor, signs an agreement to lease equipment to one of its customers. Here's the information on the agreement. First, the lease spans an 8-year period of time. The equipment has an estimated useful life of 10 years. So lease term, 8 years, 10 years, economic life of the asset. Okay. Item number 2, the cost of the asset for the lessor is $850,000. The fair value of the asset is $850,000. So what we know is if this is classified as a capital lease by the lessor, it's going to be considered a direct financing lease because there's no dealer profit. There's no dealer profit because the cost of the asset to the lessor is equal to the fair value of the asset to the lessor. We're told in number 3 here that the asset is going to revert to the lessor at the end of the lease term. That tells us that there's no change of title. And the asset is expected to have a residual value of $92,457. This residual value is not guaranteed. So we've got $92,547 unguaranteed residual value. Lessee assumes direct responsibility for all executory costs, things like insurance, taxes, that sort of thing. The agreement requires equal annual rentals beginning on January 1st, 2014. January 1st, 2014 is the day that we entered into the lease. So what this tells us is that this is, for present value calculations, this is going to be a present value of annuity due because the first payment occurs today rather than at the end of the first interest period. We're also told here that collectability of the lease payments by the lessor is reasonably assured, and there's no important uncertainties concerning the amount of costs yet to be incurred by the lessor. In other words, collectively, number 6 tells us that the lessor is going to collect and that the lessor has pretty much done everything that they're required to do under the terms of the lease. All right. So in part A of the problem, we're asked to assume that the lessor desires an 8% rate of return on its investment, and based upon that, calculate the amount of the annual rental payment that the lessor is going to charge. Here's how the lessor is going to determine the amount of the rental payment to charge. The lessor is going to say, okay, well, the fair value of the equipment today is $850,000. The fair value of the equipment at the end of its lease term is going to be $92,547. But the value today of the right to get something worth $92,547 at the end of the lease term is not $92,547. It's something less than that because of time value money consideration. So what I got to do is I've got to take that $92,547 and I've got to roll its value back to today by discounting. So what I'm going to do is I'm going to use the present value of the single sum, where the interest rate is equal to the rate that the lessor desires to earn on the lease, 8%, and N is the number of interest periods before the lessor gets the property back from the lessee. That present value single sum factor, if you dig through the interest tables or use your calculator, is 54027. So I take that 54027 present value single sum factor, multiply it times the value of the of the leased asset at the end of the lease term of $92,547, and the result of that calculation is $50,000. So, if the value of the equipment today is $850,000, and if the value today of the equipment that I'm going to get back 5 or 8 years from now is $50,000, the difference that I have to recoup in terms of lease payments from the lessee in a present value sense is, let's round it up and call it $800,000. So the question is then, what interest payment amount, when multiplied times present value annuity due factor, where that factor reflects an 8% interest and reflects 8 payments, yields $800,000 of present value? Well, I plug into the present value, or I refer to the present value annuity due table. I find that factor is 6.20637. Multiply that times some unknown payment amount and set that equal to $800,000, which is the amount I have to recoup from the lessee. And so, bottom line, solve for the unknown. The payment that I'm going to charge this lessee that will allow me, the lessor, to earn a 8% rate of return on my investment is $128,900. So, the lessor is going to book the lease on the day they enter into the lease by debiting the lease receivable account and crediting the equipment account. The amount of the debit to the lease receivable account is simply equal to the present value of the minimum lease payments plus the present value of any unguaranteed residual value. The present value of the minimum lease payments is $800,000, and that's calculated by taking the recurring payment amount of $128,900 and multiplying that times present value of an annuity due factor for I is equal to 0.08, N is equal to 8, which we determined right here to be 6.20637. Multiply that 6.20637 times the 128,900, and you come up with present value of minimum lease payments of $800,000. The unguaranteed residual value, we calculated that value up here to be $50,000. So, present value minimum lease payments of $800,000 plus $50,000 of present value unguaranteed residual value together gives us the debit to the lease receivable account of $850,000. The equipment account for the lessor is going to be credited by the amount at which that equipment is recorded on their general ledger, and the facts of the problem above tell us that that equipment is carried in the accounting records of the lessor at $850,000. So that's the entry that the lessor is going to make on the day they enter into the lease agreement. Okay, let me clean out some space here and we'll continue. Okay, so now the problem asks us to prepare an amortization schedule throughout the remaining life of the asset. And so the debit to the lease receivable account is going to appear as the balance in the receivable account column at 1/1/2014. We've got a column for the payment amount, a column for the portion of the payment that is considered interest, and a column for the portion of the payment that's considered principal. Okay, so the first payment is going to be made on the day that we enter into the lease, which is 1/1/2014. The payment amount is going to be $128,900. All of that payment is going to be deemed a payment of principal because there has been no passage of time and therefore no opportunity for interest to accrue. So the balance at the close of business 1/1/2014 on the receivable is the $850,000 initial amount of the receivable that we booked here, minus this portion of the payment that was deemed to be principal. So receivable balance close of business 1/1/2014 $721,100. Okay, the second payment is going to take place on January 1st, 2015. So the payment, of course, all the payments here in this column are the same. The portion of that payment that is deemed to be interest is calculated by taking the carrying amount of the receivable at the beginning of the period and multiplying it times the 8% rate of interest that the lessor, the implicit rate on the lending agreement. 8% of $721,100 gives you $57,688. The $128,900 payment amount less the portion of the payment that's interest gives you the portion of the payment that's principal. Obligation at the beginning of the period here less the portion of that payment that is principal here gives you a balance of $649,888. Receivable balance close of business 1/1/2015. That process is going to continue for each year. Just for the sake of completeness, I'm going to do one more year. I'm going to do the third payment here that takes place on 1/1/2016. Payment amount is $128,900. Portion of the payment that is deemed to be interest is calculated by taking the carrying amount of the receivable at the beginning of the year, multiplying it times the 8% implicit rate on the lease, and that gives you the $51,99104. The portion of the payment that's characterized as principal, the $76,908.96, calculated by taking the payment amount, subtracting the portion of payment that's deemed to be interest. That principal amount reduces the amount of the carrying amount of the receivable, so the carrying amount of the receivable goes down from $649,888 at the beginning of the year to $572,979. Okay, so that calculation process is continued all the way down through the remaining lease payments. So the last lease payment takes place on 1/1/2021, and the balance of the receivable on 1/1/2021 is $85,689.33. Okay, so now we're going to continue booking out, preparing the journal entries. We prepared the journal entry to record the inception of the lease right here. On the date that we entered into the lease, remember the first payment on that day, a payment was made of $128,900. That payment is going to go as a debit to cash here, and it's going to go as a credit to the lease receivable account there, because all the payment is deemed to be a payment of principal. Okay, at December 31st, 2014, we're going to accrue interest on this receivable by debiting interest receivable, credit interest revenue, and the amount that we're going to book that for is the portion of this payment that we're going to receive the next day on 1/1/2015, the portion of that payment that is classified as interest, which is $57,688. And again, that was calculated by taking the amount of the receivable at the beginning of the interest period, 7/21/100, and multiplying that times the implicit rate here in the lease of 8%. Yeah, 8%. Okay, so on the next day when we actually get the cash, the day after this journal entry, we go to the mailbox, open the mailbox. There's a check in the mailbox for $128,900. We're going to credit the interest receivable account for the amount of interest that we accrued yesterday, and the rest of that payment, $71,212, is going to be characterized as a payment of principal per our amortization schedule, and so it's going to go as a reduction of the lease receivable account. And then we're going to go through the accrual process again at December 31st, 2015. Per our amortization schedule, during 2015, $51,991.04 of interest is accrued. So we're going to debit interest receivable for that amount, credit interest revenue for that amount. And that amount, again, is determined by taking the carrying amount of the obligation at the beginning of the interest period of $649,888 and multiplying it times the implicit rate in the lending agreement of 8%, and the result of that calculation is the $51,991.04.